Are you about to flush $192,000 down the toilet just because you're scared of the headlines? Look at the math from 2009. Two people started with $5,000. Person A got terrified and sold everything to stay safe. They ended up with a pathetic $18,000. Person B ignored the panic and kept investing $500 a month. They walked away with over $210,000. That is a $192,000 penalty for being afraid for just 90 ghee. We are in that exact window again. If you stay scared, you will lose a decade of wealth-building progress. In this video, I will expose the media's lies, show you the exact mathematical data, and give you a three-step plan to buy dominant assets from panicked sellers at a 70% discount. Before we start, how old are you and what is the number one financial fear keeping you awake tonight? Comment below. Let's let the math do the talking. Let us begin with a study of two men. It is March 2009. Both are 27 years old. Both live in the same high-rise, earn $58,000 a year, and both have managed to scrape together $5,000 in a brokerage account. The world outside their window is screaming. The S&P 500 has collapsed 57%. Unemployment is a vertical line on a chart, heading toward 10%. CNBC has turned their graphics red, a psychological trigger designed to keep the viewer's heart rate at a resting state of panic. The first man, let us call him the victim, looks at his account, looks at the news, and feels his biology take over. His brain, wired for survival on the savannah, tells him that the tribe is dying and he must hoard his resources. He moves everything to cash. He tells himself he is being prudent. He tells himself he will wait for stability. The second man, the architect, understands a fundamental law of the elite. Stability is an illusion sold to the poor to keep them from buying the bottom. He grits his teeth, ignores the bile in his throat, and continues to invest $500 every single month. When the news gets worse, he does not flinch. He buys more. By the year 2020, the victim had roughly $18,000. He had protected his $5,000, but he had murdered his future. The architect, through the simple cold application of discipline during a 90-day window of chaos, sat on over $210,000. Same starting point, same income. The only difference was that one man let his nervous system make his financial decisions, while the other let the math do the talking. We are in that 90-day window again, right now. As of early 2026, the geopolitical landscape has shifted into a configuration of extreme tension. On February 28th, kinetic strikes between the United States, Israel, and Iran sent a shockwave through the global energy markets. The Strait of Hormuz, a 21-mile-wide choke point that serves as the jugular vein of global civilization, was effectively throttled. This channel carries 20% of the world's daily oil supply. When it narrows, the world starves for energy. Before the strikes, oil sat at $72 a barrel. By the end of March, Brent crude had exploded to $118. That is a 63% spike in 30 days. To put that in perspective, it is the most violent monthly move in energy prices since 1988. The market reacted with its usual lack of sophistication. It panicked. The S&P 500 suffered its worst quarter in years, dropping nearly 5%. The Nasdaq, the engine of the modern world, fell 10%. Global titans like Microsoft and Tesla saw their valuations slash by 20% or more. The VIX, which Wall Street calls the fear gauge but which I prefer to call the discount indicator, doubled. It spiked from the mid-teens to over 35. The CNN Fear and Greed Index bottomed out between 8 and 17. These are extreme fear readings that occur on only 3.4% of all trading days. The financial media is currently doing exactly what it is paid to do, sell you fear so you will buy their sponsors' products. They are telling you to hide. They are telling you to buy gold and buried cans of food. But here, we do not look at headlines, we look at the ledger of history. To understand why this moment is an opportunity and not a catastrophe, you must first understand the anatomy of the fear that is currently gripping your throat. The bear case is simple. Oil spikes, which drives up the cost of manufacturing, shipping, and food. This triggers a second wave of inflation. If inflation rises, the Federal Reserve cannot cut rates. If they raise rates to fight the energy spike, they slow growth. Slow growth plus high inflation equals stagflation. This is the ghost of 1974 that haunts every economist over the age of 60. But here is the hard truth that the doomsellers will not tell you. Comparing 2026 to 1973 is an act of intellectual bankruptcy. It is like diagnosing a patient with the plague because they have a cough. Yes, the symptoms overlap, but the underlying biology is unrecognizable. In 1974, inflation was a runaway train at 10%, heading for 14. Unemployment was at 9%. GDP was shrinking. Most importantly, the United States was a hostage to foreign oil. We had no leverage. Wages had automatic cost of living adjustments baked into them, creating a feedback loop where inflation fed itself until Paul Volcker had to break the back of the economy with 20% interest rates. Now look at the reality of today. Inflation is at 2.7%. Unemployment is at a healthy 4.2%. GDP is still in positive territory. The United States is no longer a hostage. It is the world's largest oil producer. But the real X factor, the one that the 1970s could never have imagined, is the surge in productivity driven by the mass adoption of artificial intelligence. Productivity is currently growing at over 4% annually. AI is acting as a deflationary hammer, crushing the costs of labor and intelligence in a way that makes a decade-long stagflationary spiral mathematically improbable. The structural conditions for a 1970s disaster simply do not exist. Professional models place the probability of stagflation at 20 to 40%. Is that elevated? Yes. Is it the base case? Absolutely not. The market, in its infinite fragility, has already priced in the worst-case scenario. This means that if reality is even slightly better than a total collapse, there is only one direction for prices to go: up. If you are starting to see the gap between the headlines and the math, I want you to answer this honestly in the comments. Are you currently making decisions based on your bank balance today or your net worth 10 years from now? This is the identity trigger. Admit which side you are on, because you cannot change your destination until you admit where you are standing. Let us look at the data provided by RBC Wealth Management. They analyzed 20 major military conflicts since 1950: Korea, Vietnam, the Gulf War, Iraq, and Ukraine. Across every single conflict, the average decline for the S&P 500 was a mere 6%. The market found its bottom in an average of 13 trading days. It fully recovered all losses in an average of 28 trading days. Think about that for a moment. In less time than it takes for a credit card billing cycle to reset, the entire catastrophe is usually over and the recovery is already in motion. While you are sitting on the sidelines waiting for a sign from the heavens that it is safe to invest, the elite have already bought the dip, rode the recovery, and are preparing to sell back to you at the new all-time highs. When Iraq invaded Kuwait in 1990, the market dropped 15%. Within a year, it was up 29%. Even during the darkness of World War II, the Dow Jones gained 50% between 1939 and 1945. The American economy is a massive self-healing organism. It is designed to absorb shocks. Unless the shock literally halts the functioning of the internal combustion engine of capitalism, the market will eventually resume its march upward. Here is the perspective that separates the 1% from the masses. Over the last century, the average bull market has lasted nearly 5 years with a 177% return. The average bear market? Only 18 months with a 35% decline. If you look at any 10-year rolling period in history, the market has been positive 94% of the time. If you look at any 20-year period, that number becomes 100%. There has never been a 20-year period in the history of the United States stock market where you lost money. Not through world wars, not through the Great Depression, not through oil embargoes or global pandemics, zero exceptions. None. So why does everyone feel like they are losing? Why does the average investor underperform the very market they are trying to beat? The answer lies in the biology of the brain. Daniel Kahneman and Amos Tversky, the fathers of behavioral economics, proved that the pain of losing a dollar is twice as intense as the joy of gaining one. Your brain is a loss aversion machine. When you see your portfolio turn red, your amygdala hijacks your prefrontal cortex. It screams at you to stop the pain. It tells you to sell. This is the mechanism that creates the investor gap. For the 30 years ending in 2015, the S&P 500 returned over 10% annually. The average retail investor, however, captured only 3.6%. Why? Because they sold when they were scared, and they bought when they felt safe. They missed the recovery. This is the most dangerous mistake you can make. Data from JP Morgan shows that if you had $10,000 invested over 20 years, it would have grown to over $64,000. But if you miss just the 10 best trading days, 10 days in 2 decades, your final balance drops to $29,000. You lose more than half your wealth by missing 10 days. And here is the kicker: 76% of the markets. Best days happen during bear markets or in the first 2 months of a new bull market. In other words, the days that build your wealth happen exactly when the world feels like it is ending. If you are out of the market because you are waiting for things to settle down, you are guaranteed to miss the very days that make the entire journey worth it. You are literally paying a fear tax to the people who have the stomach to stay in. I want to pause here. I know many of you are feeling a specific kind of pressure. Maybe you have a mortgage or children, or you are looking at the price of groceries and feeling like the ground is shifting beneath your feet. This is the suppression release. Tell us in the comments. What is the one financial fear that keeps you up at night? Let it out. This community is a safe harbor for those who want to move past the fear and into the light of logic. Now, let us discuss the action plan. We do not gamble at Channel. We engineer outcomes. I cannot tell you where the market will be in 6 months, and neither can the gurus on television. But I can give you a framework that works regardless of what the Strait of Hormuz does tomorrow. We call this the Sovereign Portfolio Framework. Part 1 is the fortress. At least 40 to 50% of your capital belongs in a broad market S&P 500 index fund. This is your foundation. It has a 100% success rate over 20 years. You are not betting on a company. You are betting on the collective ingenuity of the human race. At current levels, with the market sitting nearly 9% below its highs, you are buying the fortress at a discount. Part 2 is the growth engine. This is where you layer in high-quality, dominant individual companies. We are talking about businesses with massive moats, companies whose earnings are not dependent on geopolitical peace, Microsoft, Amazon, Meta, Google. These are not just stocks, they are the digital infrastructure of the 21st century. They are currently available at prices we haven't seen in months because fear has disconnected their price from their value. Part 3 is the predator mindset. Discipline. You must continue to invest every single month, especially when it hurts. The math of dollar cost averaging is a beautiful thing. When the market drops 30%, your monthly $500 doesn't just buy stocks, it buys 43% more ownership of the world. When the market drops 40%, you are getting 67% more shares for every dollar. You are not losing money when the market goes down. You are accumulating power at a lower cost basis. The Amazon investor from 2009 didn't get rich because he was a genius who predicted the rise of cloud computing. He got rich because he had the nerve to keep buying when General Motors was going bankrupt and banks were being bailed out by the billions. He bought Amazon at a split-adjusted price of $1.75. Today it sits over $200. That is a 120 times return. That is the reward for looking at a world in flames and deciding to plant seeds anyway. One final truth that the global media misses: when the world gets chaotic, the money does not disappear, it migrates. And it always migrates to the same place, the United States dollar. Over 60% of the world's foreign exchange reserves are held in dollars. The U.S. Treasury market is a $24 trillion ocean of liquidity. It is the deepest, safest pool of capital on the planet. During the height of the 2026 tension, the U.S. dollar index surged. Why? Because when a billionaire in Europe or an institution in Asia gets scared, They do not buy gold. They buy U.S. treasuries. They buy the American system. This influx of global capital acts as a massive shock absorber for our markets. Global chaos and U.S. market performance often move in opposite directions because of this flight to quality. Goldman Sachs has a year-end target for the S&P 500 that is roughly 16% above where we are currently sitting. They note that the balance sheets of households and corporations are remarkably healthy. There is no subprime time bomb this time. There is no shadow banking collapse. There is only fear. And fear is the most transient force in the financial universe. Right now, you are making a decision. Even if you do nothing, that is a decision. You have three paths in front of you. Option 1 is to be the victim, sell everything, go to cash, and wait for safety. This is the most expensive mistake you will ever make. You will miss the 10 best days, you will buy back in at higher prices, and you will spend the rest of your life wondering why the math didn't work for you. Option 2 is to be a spectator. Hold what you have, but stop adding. You will survive, but you will not thrive. You will miss the opportunity to lower your cost basis and capture the asymmetric upside of the recovery. Option 3 is to be the architect. Stay on schedule. Keep your emergency fund intact, but take the capital you were going to invest anyway and put it to work. Recognize that the red on your screen is not a warning, it is a clearance sale. The window is open. The data says we are likely near the peak of fear, not the beginning of it. History shows that military conflicts bottom out in about 13 days. We have passed that mark. The Iranian signals are already softening. The peace statements are starting to circulate. By the time the news confirms that the war is over, the best prices will be gone. The 2009 window lasted 3 months. The 2020 window lasted 5 weeks. This one is open right now, but the draft is already beginning to blow the door shut. The difference between guy number 1 and guy number 2 in our opening story wasn't intelligence. It wasn't their salary. It was their ability to divorce their financial actions from their emotional reactions. One man saw a crisis, the other saw a discount. One man retired with $18,000, the other retired with a fortune. As for those of you still watching, the ones who have stayed until the very end, I have a final truth for you. The reason most people never become wealthy is not because they lack opportunity. It is because they lack the character to endure the process of becoming wealthy. Wealth is a test of the spirit as much as the mind. If you can look at a world that feels like it is ending and see the beginning of your legacy, you have already won. If you are one of the ones who will act, I want you to leave a sign. Comment with the words, "I am the architect." This is our secret password, a way for us to identify the visionaries who are actually paying attention. Wealth is a choice. Today you choose. If this analysis provided you with the clarity you needed to navigate these turbulent waters, do not just keep it to yourself. Like this video, subscribe, and share this with one person who is currently being blinded by the headlines. We are building a community of the 1%, and it starts with spreading the truth. The world is noisy. Stay focused on the math. I will see you in the next video, which is appearing on your screen right now. Click it. The education of a visionary never stops.